What is going on, guys? This is Riado and welcome back to the channel. This is part 2 of my PayPal stock analysis, and if you're interested in watching part 1 where I talk more about the company and its growth, you can click the video right here, or you can find the link to part 1 in the description down below. With that said, let's jump right into part 2 of the analysis. So let's look at the company's profitability, and before we move on, I just want to point out that PayPal does not report gross margins but instead report transaction margins, which is basically revenue minus volume-based expenses. So volume-based expenses are variable expenses, and it is basically transaction expense and transaction and credit losses combined together, and when you subtract volume-based expenses from net revenue, you get transaction margin, which I will name it as gross margin in my analysis, so just keep that in mind. This way we can look at PayPal's gross margin profile and we can figure out if PayPal is achieving economies of scale or not. And the rest of these items under operating expenses are actually the fixed overhead expenses, which are typically reported under operating expenses. With that said, gross profit or transaction profit was 13.8 billion, which is a 50% gross margin, and in Q1 it was 3.3 billion, which is a 47% gross margin. As you can see, gross margins have been decreasing over the last few quarters due to growth of unbranded processing volume outpacing the growth in branded processing volume. And as I mentioned earlier, unbranded processing has lower take rates than branded processing, and I do expect gross margin to continue to decrease in the short to medium term as PayPal's unbranded business continue to outpace overall growth. Benefit from the release of credit reserves in the previous year and management increasing credit reserves due to a challenging macro environment also explain why gross margins were higher in 2021 and lower in 2022 and in Q1. Nonetheless, this is the part where most investors are worried about, as a decline in gross margins means pressure from competitors, diseconomies of scale, and a decrease in earnings potential. Moving on to operating profit, I've included both GAAP operating margin and non-GAAP operating margins, which adds back share-based compensation and restructuring expenses. As you can see, GAAP operating profit in 2022 was 3.8 billion, which is a 14% GAAP operating margin and a 21% non-GAAP operating margin. And in Q1, GAAP operating income was 1 billion, which is a 14% GAAP margin and a 23% non-GAAP margin. So despite gross margins declining year over year, operating margins actually improved year over year, showing operating leverage, and the reason for this improvement is due to non-transaction expenses dropping down by 12% as the company reduces employee headcount. But I also want to point out that there's a quarter-over-quarter dip in GAAP operating margins in Q1, and this is actually due to higher restructuring charges. So once these charges phase out, operating margins should improve moving forward. Moving on, net profit for 2022 was $2.4 billion, which represents a 9% GAAP margin and a 17% non-GAAP margin. So net income actually dropped by 42% in 2022 due to losses in strategic investments and higher tax expenses. But in Q1, net income was 795 million, which is an 11% GAAP margin and a 19% non-GAAP margin. So net income margin wise, things are looking better, and I expect these to improve as the company gains operating leverage from increased focus on cost control. So all in all, the concern with PayPal is that PayPal's gross margin is declining due to changes in volume and funding mix, which shows diseconomies of scale. But on the other hand, operating margins are actually improving as the company reduces costs, which shows operating leverage. So it's a mixed bag for me. Clearly, the markets don't like the fact that margins are compressing and growth is slowing down, which is why PayPal stock has been selling off like crazy. But I just want to say, PayPal sell-off feels very similar to Meta platform. As you may know, Meta platform sold off more than 75% of its value due to the same reasons as PayPal. Macro conditions aside, Meta sold off because of slowing account growth and declining margins, which is what PayPal is experiencing right now. And then Meta announced the year of the efficiency, and then the stock took off. And I think we can see the same thing happening to PayPal stock once growth returns to normal and margins improve. But I will talk more about that in the valuation section of the video. Also, if you want to check out my Meta stock analysis, you can click in the link right here, or you can find the link in the description down below. Now turning to the balance sheet, PayPal ended the quarter with $10.7 billion in cash and short-term investments with $11.6 billion of total debt, which brings its net cash position to about negative $900 million. Current ratio sits at around 1.3 times. Not the best figure, but PayPal's balance sheet is strong enough given that the company is free cash flow positive. As you can see, PayPal is a free cash flow machine, generating $5.1 billion of free cash flow in 2022 at a free cash flow margin of 19%. On the other hand, Q1 free cash flow was $1 billion, which is a 14% free cash flow margin, and we can see that margins dipped slightly in Q1, and this is due to higher cash taxes related to the transfer of intellectual property of $430 million. Excluding from this impact, free cash flow margin would have been 20% in Q1. But the question is, if PayPal is producing so much free cash flow, why are we seeing its net cash balance dropping? Well, that's because the company is buying back its shares so aggressively, and as you can see, on a trailing 12-month basis, PayPal returned $4.1 billion to stockholders by repurchasing 48 million shares, which is more than 80% of its free cash flow. And in Q1 alone, the company bought back $1.4 billion worth of shares, which is 140% of its free cash flow. I've never seen a company buying back shares this aggressively, and I think it's a really good use of capital now given that PayPal stock keep making new lows. And last June, the board of directors also authorized a $15 billion stock repurchase program, and as of Q1, PayPal still has $14.4 billion left available for future repurchases, which is roughly 20% of its market cap today. So as PayPal continues to buy back shares on the cheap, we can expect earnings per share growth to accelerate because of lower shares outstanding, which should reward shareholders in the long run. Again, this is very similar to Meta Platforms, which was also buying back shares like crazy when the stock sold off. In terms of outlook, management provided the following guidance. In Q2, PayPal expects revenue to grow 6.5 to 7% and 7.5 to 8% on a currency neutral basis. Non-GAAP operating margin is expected to be 22%, which is a 300 basis points improvement from last year's 19%. Non-GAAP earnings per share is expected to be $1.16, which is up 25% year over year, and this is due to the cost-cutting measures as well as share buybacks. GAAP earnings per share is expected to be 82 cents compared to negative 29 cents last year, and so last year was very negative due to a negative impact of approximately 45 cents on PayPal's strategic investment portfolio. So overall, Q2 guidance is quite weak on the top line, which is maybe why the stock sold off after Q1 earnings results. On the other hand, earnings per share outlook looks solid. For the full year, management expects revenue growth in the back half of the year to be in line with the first half of the year, so call it about 7 to 10% growth in Q3 and Q4. Management also raised non-GAAP earnings per share guidance by 2 percentage points, growing by 20% year over year to $4.95, reflecting ongoing benefit from cost-cutting initiatives. On the other hand, management lowered their guidance on non-GAAP operating margin and is now expected to expand by 100 basis points instead of 125 basis points, reflecting a greater contribution of unbranded processing volume to growth. I guess this is yet another reason why the stock sold off after Q1 results, and that being said, non-GAAP operating margin is expected to be 22%. Moving on, free cash flow is expected to be $5 billion, reflecting headwinds from higher expected cash taxes, and the company also expects to allocate $4 billion for share repurchases, which is about 80% of free cash flow. So all in all, guidance looks okay. I mean, the slowing revenue growth is a concern, but earnings per share is expected to grow double digits. In addition, free cash flow remains robust and the company still intends to be active in buying back shares, which is great to hear. If we head on to Seeking Alpha, which shows PayPal's actual revenue and consensus estimates, we can see that PayPal seems to be right in line with analyst estimates with no big upsides or downside surprises. So moving forward, I don't expect massive misses or beats for PayPal. With that said, management seems to be focusing on growing its unbranded business through Braintree and PayPal Complete Payments. Again, Braintree is an enterprise-grade payment processing service for merchants, and PPCP is an end-to-end full-stack payments platform for small and medium businesses. So during the earnings call, management mentioned that they also want to improve the margin structure of its unbranded business through PPCP, which opens a new $750 billion total addressable market in the small and mid-sized market, which has significantly enhanced margin structure compared to its largest enterprise customers. Braintree and PPCP are also also expanding overseas where they can drive higher margins as well. And finally, the company expects to add value-added services to its platforms to enhance functionality and add incremental margins. So with these initiatives, we can expect margins to stabilize or even improve, even with unbranded processing outpacing overall business growth. It is also worth mentioning that PayPal is looking to sell its Zoom unit, which the company acquired in 2015 for $890 million. So a sale could boost cash levels, and I expect PayPal to use that money to lower its debt level or even buy back more shares. Let's now take a look at valuation, and I just want to say this outright. PayPal stock is dirt cheap, and after losing 80% of its value from its all-time highs, I think it's a very interesting buy at just $63 a share. By all valuation multiples, PayPal is trading at the lowest valuation ever since it went public in 2015. As you can see, PayPal is trading at just 12 times price to earnings ratio and 2.3 times price to sales ratio, which is well below its historical averages. And of course, the markets are discounting PayPal's slowing growth as well as a challenging macro environment, but PayPal's fundamentals remain strong and the long-term growth thesis for the company remains intact. So I think PayPal is in deep value territory here. And if we head back to Seeking Alpha, we can see that Wall Street has a buy rating on PayPal with 23 strong buys, 10 buys, and 14 holds with no sell ratings at all. And if we scroll down, we can see that the average price target is $98, which is a 55% upside from here. And the price target ranges from a high of $200, which is about 100% upside from here, and a low of $58, which represents a minimal downside risk. So I also did a DCF analysis on PayPal as a sanity check to analyst price targets and also to find the intrinsic value per share of PayPal stock. So these are my key assumptions for my DCF model. So first we have revenue growth, and I followed analyst estimates for the first 3 years, and then I'm gonna plug that in right here, and then I'm gonna gradually drop it to 8.4% revenue growth by 2032. For cost of revenue and operating expenses, I've set them in such a way that we achieve an operating margin of 14% in 2023, which is in line with last year's operating margin profile. And over the next decade, I expect margins to improve to 17.6% by 2032 as the company achieves economies of scale and operating leverage. Income tax is going to be about 25% this year, and I'm gonna set it at 20% for the rest of the years. As for the calculation of free cash flow, I will be adding back transaction and credit losses right here. So if we look at PayPal's cash flow statement, we can see that PayPal adds back transaction and credit losses to calculate its cash flow from operations, since this is a non-cash expense. So I will include that in my model. So as a percentage of revenue, PayPal's transaction and credit losses is about 5 to 8% in the last 5 years. So for me, I will be using 5.5% in 2023 and then improves to 4.6% by the end of 2032 as the company develops better technology for the provision for transaction and credit losses. And for depreciation and amortization, stock-based compensation, capital expenditures, and changes in net working capital, I'm going to set them at a constant of 3.2%, 4%, 3%, and 3% of revenue respectively. So with these assumptions, I will arrive at a revenue of $63 billion by 2032, and free cash flow is expected to be about $5 billion, which is in line with management's guidance. And by 2032, we will arrive at a $12.5 billion free cash flow at a free cash flow margin of about 20%. And assuming a discount rate of 10% and a 2.5% perpetual growth rate, I arrive at an intrinsic value per share for PayPal stock at about $104 per share. As you can see, this is slightly higher than the average price target set by analysts, which is about $98. So based on my DCF model, the risk to reward on PayPal stock seems very attractive with an upside potential of 65%, which is why I started a position in PayPal. So the current price is about $63 per share right now, and this is where my margin of safety price is, which is about $62 a share. And that is exactly where I started my position in PayPal. So as you can see right here, I think the current price of $63 is at undervalued territory. On the other hand, institutions have actually reduced their exposure in PayPal, but there were some very notable buys as of recently, including activist investor Elliott Management's $2 billion stake in PayPal back in August, as well as Ray Dalio's Bridgewater Associates adding to their PayPal position in Q1. So this should boost investor confidence. Not only that, but outgoing CEO Dan Schulman just bought $2 million worth of PayPal stock back in February, and given the prices that we've seen today, we may see additional insider purchases over the next few months or quarters, which could turn around the stock for good. So before we move on, I want to compare PayPal's price action with Meta as well. Here we can see that PayPal and Meta stock began their collapse in late 2021, but the difference is Meta bottomed in November 2022 while PayPal continued to trade sideways. If you've been following Meta in the past 2 years, you'll know that there has been so much negativity on Meta stock as it sold off. There's the slowing user growth, margins declining, increasing competition, and so on. Then Meta posted Q3 results, which saw the stock drop 25% the next day due to weak guidance, but within a few days, there was a change in sentiment as the company announced layoffs and focuses on delivering the year of efficiency, and before you know it, the stock is up 200%. So I think it may happen to PayPal as well. It's going through very similar challenges like account growth slowing down, margins compressing, and increasing competition, and the company also provided weak guidance, which caused investors to panic sell, causing the stock to drop 12% the next day. I think there's a great opportunity to accumulate shares right now, given that there's a large margin of safety, and I think the best time to buy is when the outlook is awful, as we've seen in the case of Meta, because when the outlook improves, the stock would have been significantly higher and we would have missed most of the gains. So yes, there's a lot to like about PayPal at $63 a share, but I'm not a financial advisor, so don't forget to do your own due diligence. So before we wrap up, let's talk about the risks, and I think the first major risk is competition. There are many big tech companies out there that are expanding aggressively into the payment space. This includes Google Pay and Apple Pay, and we know how large their consumer and partner network is. Then there's other fintech platforms like Adyen, Block, which owns Square and Cash App, Affirm, SoFi, Chime, M1 Finance, Acorns, Coinbase, and many more. And these platforms are growing fast and they can take market share away from PayPal. The next major risk is management changes. As you may know, there has been some management changes as of lately. First, CFO John Rainey left the company to join Walmart after 7 years with PayPal, and then the Chief Product Officer was also replaced in September last year. Next, replacement CFO Blake Jorgensen also stepped down in less than a year due to medical reasons. And finally, CEO Dan Schulman is expected to retire by end of year after 9 years with the company. So lots of management uncertainties for PayPal, which could make or break the company. And the last risk will be that PayPal never returned to growth mode and instead continued its downward spiral of slowing growth and eventually to negative growth. When things don't improve, PayPal's valuation may be re-rated to lower multiples, which could pressure the stock for years. So yes, there are risks with investing in PayPal stock, some of which include increased competition, changes in management, and continued growth slowdown. To make matters worse, management gave weak guidance for the rest of 2023, expecting that the company will only grow by single digits this year, which is not enough to get investors excited, and which is why the company has been selling off lately. But I think poor outlook and poor investor sentiment have created enough fear for PayPal stock to be an attractive investment for me. As seen in the case of Meta, the best investments come when there's a high quality company trading at a large margin of safety to intrinsic value, as well as when the future looks like doom and gloom for the company. With that said, I am buying the fear, and I'm confident that PayPal has the scale, brand, and network effect moats to weather the storm and continue growing as the leader in the fintech space. Plus, earnings per share is growing, TPV is growing, engagement remains high, the company is a free cash flow machine, and the company is buying back shares aggressively. So if you're an investor in PayPal and you're deep in the red, just hold on to the stock and be patient, as I think it will turn around soon. And for those who are looking for an investment opportunity, you might want to consider PayPal. With that being said, what do you think about PayPal stock? Please let me know in the comment section down below. And if you haven't done so, please hit the like button and subscribe to my channel for more investment content. As always, thank you for watching this video. I appreciate you and I hope you have an amazing day. Thank you, and I'll see you guys on the next one.